Indian stock market have been rallying for a while with benchmark indices hitting fresh heights recently. And while a bull market is a good sign for investors, many tend to sit back fearing correction in the short term or simply aren't aware how to invest when market scales new highs. On the ET Money show today, we have your back on this as always. And as market inches towards fresh highs, we will tell you how you can make your investments wisely and get the most out of it. And for this, we are joined by Santosh Navlani, CEO, ET Money. Santosh, good evening. And first question to you, the reason behind the market rallying these days?
Hi, Kavita. So I think I have this belief that markets actually do what they do, and then you justify what might have caused those moves. And this time, maybe no different. Nobody expected that markets would actually suddenly start bouncing from the lows that we saw a few months ago. I think right from July, they've been rallying in some way or the other, maybe taking a pause here and there. But right now, what we are seeing is a daily new all-time high. And that basically creates a lot of fears in people, and doubts in people, doubting the rally and everything, just because they are sitting on the sidelines and they try justifying why it should not rise. But let's understand why it is rising. I think a lot of people actually were expecting a lot more bloodbath right from end of 2021 because they're expecting central banks will raise the rates, liquidity will get squeezed. There was oil kind of getting expensive, or Russia Ukraine war as a hangover, and of course a bull market for 2 years which was completely unabated. So a lot of risks were actually on the horizon, and people were expecting that a correction will set in and will last for a longer period of time. But what we saw is a completely same replica happening, but possibly people discovered that things are not as bad as they look, because central bankers, when they started raising the rates and inflation started slightly coming down on a monthly basis, the chatter has completely changed that it's too much of rate rising is going to give a rise to recession, and because of that, central bankers may actually take a pause or go slow and rate hikes. And I think that narrative, which is becoming stronger right now, that there is might be a pause or a slowdown in the pace of hikes, that actually has given a breather into the markets, and hence maybe the rallying. And of course, India has kind of remained resilient as an economy, be it the Diwali kind of sales across consumption categories, or for that matter, the results, which actually have not been a mixed bag. They've been more positive than negative. I think, and even the banking sector is showing signs of a tremendous amount of growth and sustainability right now. So a lot of positives getting priced in, and markets actually taking a right up move at this point of time. But I think risks are still on the horizon. I wouldn't really say this a runaway rally. I think if you have an investment strategy in place, you may be better prepared to make returns out of this market.
Most important thing, if you have an investment strategy in place, you should really have no fear about market making new highs every day. But then let's talk about those investors who really fear this kind of a bull run, who are scared of market reaching a new high every day. And in fact, what they do is whenever the market reaches a new high, they try and book some profit. Do you think that's the right strategy? And the fear of market falling down is a very natural human fear or a behavior towards the market movement. But then how can you rationalize this and actually make it work for you to invest better and to have a better corpus?
Yes, so Kavita, I think it's a pretty personalized answer to everybody's situation that I would be forced to give. I don't think there is one answer for everybody. There may be people who just started investing in 2022 for the first time, and there may be people actually who've been investing for a while, since say 2019 and 20, and maybe people who actually been investing since most part of this decade itself. So I think it depends on when you entered the market would possibly be governing how you should behave right now. And I think at DT Money, we always been a believer that you cannot take a call on market levels or valuation in isolation. You have to look at a lot of things in combination. First being your own financial goals, your own risk appetite, which governs your asset allocation and investment plan. And of course, on the side, you would actually look at how soon you require money at this point of time, and what are the other indicators like interest rates or kind of liquidity in the marketplace telling you. So if I would look at all these things, I would be giving a very simple answer that look at your asset allocation plan, and if you believe, if you understand from it that you've deviated way too much from the ideal allocation for yourself, then go and book some profits. Don't just book profits because there is a new all-time high in the marketplace right now. So, for example, if you're somebody who actually is investing for a mid-term goal and intending to maintain a 50-50 equity allocation and debt allocation in the portfolio, and if because of markets rising almost good 20% in last few months, your allocation has become like 60-40 in favor of equities, go and book that 10% kind of profit, or rather take out that 10% from equities, so that you go back to 50-50. In this way, you just not book profits but also rebalance your portfolio. So I would always recommend on the side of go and rebalance your portfolio, and if that means that you end up booking profits unknowingly or you end up booking profits knowingly, do that, but don't take a call to book profits or take some money off the table just based on valuations.
Stopping your investment, because a lot of investors are actually worried about the ripple effect of a global recession and a high inflation rate going on globally, and the slowdown growth concern at a domestic level also. What about these kind of investors who look at this market high and then maybe miss an opportunity to invest? Do you think investing in this current market level will actually help you get better returns?
Yeah, so Kavita, to answer this question, I would again go on the data to guide us, and we looked at this data pattern for markets for Nifty since April 2008 till March 2022, and over this 15-year period, 15 financial years, if I can say that, we actually looked at eight market events where markets were actually close to all-time high. And if there was an investor who didn't believe in investing regularly via an SIP or some methodical way, but believed in timing the market on the reverse, only investing in markets are high, and you invested on these eight events your money where markets are all time high, you still actually make good 9 to 14% CAGR on each of the financial year investments, and that is not bad at all. So when people will tell you that if you invest in all-time high, then possibility of making returns is low, that is not a straight answer in our opinion. A 9 to 14% CAGR over each of your investment of these eight all-time market events in last 15 years is actually quite good. So it just breaks the notion that investing at all-time high makes you lose money. And look at the other side of the whole thing, that if you're somebody who's believing in SIP way of making investments and had an SIP since April 2008 till March 2022, and just because you actually felt like markets are actually quite wobbly or they are way too high, and I don't know I should be investing, you take a pause and skip about 20 selective best days of the market, your returns are actually 40% lower compared to what they should be. So what happens is, if you miss out the best days in the marketplace, they may be just 20 out of so many trading days, you still make less money. So probability of you getting your timing right, be it near all-time high or be it near all-time lows, is actually way too less as a retail investor. And it's far better that you have an investment plan and continue with investment plan rather than actually timing the market. And there is a big saying in the marketplace, like, it's time in the market which makes more money than timing the market. And I think I would rather err on the side of staying in the market, even if that means that I'm not putting all my money in equities. Maybe I'm always staying 60-40, 70-30, 50-50. At least always have some exposure in marketplace based on asset allocation plan. And that will probably see you through far better than actually sitting on this cash and full equity, depending on market direction.
Acha, a lot of experienced investors, I would like to use experience because they think that they really know how to play well during these market movements or market rallies. They try to time the market. How does one do this? And is it a good idea to time the market, especially if you're a long-term investor?
I wish I can answer that how they time the market properly. I'll be forced to learn from them. But Kavita, I think if you look at the whole thing in a very rational way, I think timing is far more difficult for not just reasons of one's understanding of markets, because markets actually are typically responding to events which are non-market driven. Like markets may be responding to political conditions, market may be responding to liquidity conditions, which are not in your control. There is always saying, "Don't fight the Fed," right? So, but you don't know what Fed is doing. If look at March 2020 scenario where actually the world was about to get locked down, or was most of the countries were actually not operating in their economies in normal fashion, and market was falling because of scare of the risk that earnings were actually getting exposed to. And then comes Fed, which actually announces a mega liquidity plan by printing money or quantitative easing, what do you want to call it. US government actually transferring money to residents of US in that time, and then Indian government taking steps in terms of providing credit guarantee schemes, or RBI reducing interest rates and maintaining liquidity in the marketplace. So you can't project or predict these events as an investor, that all things will come together, they will lift all the boats at one go, and the market is going to get benefited. At no point of time on March 23, 2020, when we hit a low on Nifty, and then there was a runaway rally after that, nobody would have predicted. And I think all of 2020, most of the experienced market experts were actually calling the rally as a fluke and not really believing in the rally itself. So, in my opinion, most of the experts were actually not positive on March 23rd, 2020, or they continued to really question the rally in 2020. And only in some time in 2021, people actually became positive towards the rally, towards when market was actually rallying from 12,000 to 18,000 levels. So I think it's a matter of getting everything right, not just market understanding, but your political, economic, and central bank policies right, which I don't think anybody can get it right. So hence, possibly it's far too difficult time the market than it looks like.
Help me understand this current scenario of a market all-time high from a trader's point of view and from a long-term investor's point of view. Also, someone who invests into share market directly and goes to mutual funds. Investing. See, when you talk about investing, we assume that you are participating at all market levels. But then talking about a trader, how important is this high market level for a trader, and how much of a concern it is for an investor, both who's putting money as an investor in the share market and in mutual funds?
I may not be able to answer that accurately for a trader, Kavita,
Sure.
but I'll attempt it in either case. I think when you're a trader, you know that you are in the market for a few hours, or a few days, or a few weeks, or a month, and you actually have your risk completely controlled by whatever method you're following, whether you're following trends, or near-term fundamentals, or looking at liquidity conditions in the marketplace, or volumes, and multiple things which are available to a trader disposal. And one thing which differentiates a trader investor is trader will always have a stop loss. So, be it when somebody takes a bet against the market and goes short, he or she would actually have a stop loss based on a level when market crossing certain threshold. Similarly, on the way of downside as well, and when you're wanting to actually take a bet on the market will go up, and market actually continues to fall, then you have a stop loss as well, that position as well. So, what differentiates trader is actually having a very strict stop loss in your kind of trading activity itself, and that determines whether you're going to make money or not. And having a method, like are you a technical trader, or you are what kind of person you identify yourself as. On the contrary, investor is actually somebody who's looking for lower prices so that one can invest rightly. But what differentiates investor is actually knowing that how much to invest in equity at a certain level, and if you have a method for that, you will be far better off. So let's take a current example, that when the risk-free return on a government security is 7.3% right now for a 10-year investment, and you can actually safely invest in a GSEC fund or buy government securities directly from RBI Direct, then would you really go and risk all your money in equities when it is expected that when interest rates rise, markets actually tend to take a pause or don't rise completely in a one-way direction? Now, it may be different this time. Nobody knows that. But actually taking a view that one would be all equities, if you have at least a horizon of less than 10 years, then you typically would actually have some amount of debt in the portfolio. So investor would know how to diversify that. what portion of money should be in equities, what portion should be debt, should I be hedging some of my portfolio by buying gold, and things like that. So while an investor would actually look at opportunities to buy cheap, a trader will not care about valuations or prices. That person will care a lot about trends in the marketplace, and I think that's what probably will differentiate both of them, in my opinion.
Last question to you. Rebalancing your portfolio is important, but is it also important to look at your goals for which you have aligned that portfolio? A lot of times in these kind of market movements or market rallies or market highs, people might just go more closer to their corpus. Is it important to also reevaluate your goals?
I'm not sure, Kavita, because see, when you are putting a goal which is like, say, children's education, buying your dream home, or retirement, typically you would have been thoughtful about setting a date for them. Unless they're consumption goals, like you're buying something for car, buying your car, or kind of planning a vacation. These kind of goals actually may get preponed, postponed, depending on corpus getting achieved. But I think what is good part about corpus getting achieved beforehand or prior to the goal date is you can actually secure that amount completely. Take that money out and put it in a safer instrument so that at least it is not volatile anymore, and use the time available to you maybe for maximizing returns. But taking your eyes off goals is something which I would not recommend at any point of time. What you need to do is reevaluate your asset allocation plan and rebalancing strategy if markets are behaving in a very different direction altogether, and maybe kind of understand what you should do to ensure that maybe if your goal is getting reached early and you have extra time available on hand, maybe you will be able to upgrade your lifestyle, maybe upgrade the goal value itself. So I would look at on the positive side of how can you look at goal more in the center of your investment strategy than actually moving away from the goals altogether.
All right. So to sum it up, whatever you've explained us, do not sit on cash. Don't fear a market correction in the near term. Don't try to time the market. Continue your SIP even at market highs. Check if allocation to equity in your portfolio has risen significantly. Rebalance your portfolio and definitely make decision based on long-term expectations. Thank you so much, Santosh Navlani, for being on the show and explaining all these concepts to our viewers.
Thanks.